Hello all and welcome to RiskScout's webinar, Taking the CYA out of KYC. We are so excited to have you here joining us today for this excellent session. Now, before we do dive into today's webinar content, we want to take just a quick moment to roll through some housekeeping items. RiskScout will be sharing all of today's webinar resources in a follow-up email tomorrow morning, so be sure to keep an eye on your inbox. We also want this session to be as valuable for you as possible, so we encourage you to ask any questions that you may have throughout today's session in the questions section of the webinar panel on the side of your screen. We will also be running a few poll questions throughout today's session to better understand you, our audience, so your participation is greatly appreciated. Now, in case it's your first time joining us, RiskScout is a team of former bank examiners, BSA professionals, and fintech developers helping financial institutions grow and be more efficient and profitable. Through a full BSA, AML, and fraud suite, RiskScout solutions increase revenue and decrease compliance costs and losses by unlocking new deposit streams, automating compliance workflows, and catching fraudsters. If you're interested in learning more about how we help community banks and credit unions every day, visit RiskScout.com and get in touch. This month, RiskScout announced brand new fraud functionality coming to our platform. These rules and integrations help financial institutions of all sizes fight against wire fraud, ACH fraud, elder financial abuse, check fraud, new account fraud, and more, alongside our existing BSA AML suite. With real-time alerts and full fraud management built into a powerful BSA compliance solution, you can prevent losses and better protect your community from financial crime without the headaches of juggling multiple vendors and tools. Visit RiskScout.com to read the full press release and request a demo to see these new features in action. Next month, RiskScout will be hosting the webinar, Confessions of a Former Examiner, How to Pass BSA Reviews with Confidence. Bank exams can be one of the most stressful times of year for BSA AML teams, but they don't have to be. Join Ryan McInerney, a former OCC bank examiner and RiskScout's Chief Product Officer, for an inside look at what examiners are really evaluating during BSA reviews. Whether you're new to BSA or a seasoned officer preparing for your next review, this session will leave you feeling more informed, confident, and exam ready. Visit our website to save your seat today. Ladies and gentlemen, today's webinar is led by none other than Kristin Parker, RiskScout's Senior Vice President of Compliance and Operations. Kristin is a seasoned expert in BSA AML and fraud prevention with extensive experience building and implementing monitoring programs for higher risk industries. She has contributed to significant updates in the FFIEC manual, provided practical and risk-based AML guidance at industry events, and played a key role in the development of RiskScout's innovative and actionable BSA solutions. Recognized by her peers as PBC's 2024 Compliance Person of the Year, Kristin continues to champion efficient, technology-driven approaches that empower financial institutions to confidently manage regulatory requirements and fight financial crime. Without further ado, I will go ahead and pass the baton over to Kristin to dive into today's webinar content. Kristin, go ahead and take it away.
Hi, everybody. Thanks, Ethan, for that nice introduction. I'm excited to walk you guys through today's webinar where we are going to discuss all things KYC and KYB and really more practicality than anything. I'm all about, if you've been to my webinars in the past or you've worked with me in the past, I try not to overcomplicate anything. Our jobs are already difficult enough. So what we walk through today, I hope you find is practical and useful for you to take home and think through and implement in your own world that you work in. So we're going to start out just briefly talking about what is KYC, what is KYB, what is the regulatory requirements for that. What's the proper and right way, not necessarily proper, but what's a best practice for starting a new relationship what are your requirements or what are best practices for maintaining that relationship and continuing to know your customer, know your member. Common pitfalls in this space, which, whoo, man, there are tons, but KYC and KYB best practices is where we'll land, and then we'll do a little Q&A at the end.
All righty, that brings us to our first poll question, which you should see popping up on your screen now. We just want to get a quick finger on the pulse for y'all and understand how confident are you in your current KYC, KYB due diligence process. You can select anything from very confident, somewhat confident, not confident, or hey, maybe it's just a work in progress. It's coming along and we're developing it as we speak. We'll give y'all just a couple seconds to get your answers in, and then we'll turn them around and have Kristin kind of speak to the results of who we have on the call and see what's going on. Oh, excellent. Y'all are quick on the draw today. Thank you for getting those answers in. It looks like we should be seeing this turning around now. The majority of all the folks we've got joining us here today, 64% say that they are somewhat confident in their KYC, KYB program. Fortunately, almost a quarter of our respondents feel very, very confident. Only 4% not confident, 7% are actively in development. Kristin, I know you're working with banks and credit unions every single day, working on these programs. How does this kind of stack up with what you expected to see?
I am very interested in the fact that most folks are somewhat confident. I think that's a great place to be, actually, where you're always kind of questioning, am I doing the right thing here? And that is a great approach to constantly evaluating yourself and your program. Those are very confident. That's great that you feel very confident. I just always err on the side of where is that confidence coming from, and never getting overconfident, right? In what you're doing. Again, goes back to that kind of reassessing your program as it's a living, breathing thing. Not confident in its work in progress. I've been there myself. It's not an easy thing to tackle, especially if you're coming out and you're in this space where you potentially don't know what you don't know. I oftentimes work with institutions who the BSA officer comes in and they're just the teller who drew the short straw that now is a BSA officer, so they don't know what they don't know, and confidence is lacking there. So I hope as we go through this today that you guys have a little bit more confidence as we lead into there, and everybody else gets some good either relief from that you're doing what you think you should be doing, or at least some good self-assessment. Let's just start with kind of why do we have to do KYC, why KYB? Essentially it started with the Patriot Act. Beforehand, before 9/11, a lot of this this whole collecting and information was more subjective and saying it was kind of optional. You could come in and you could open an account, and what was required for you to open an account was kind of neither here nor there, or really that enforced. So when 9/11 happened, that changed, because obviously there were situations where if money was flowing through accounts in certain US-based institutions who didn't quite identify who was involved, and if they had, could they have helped prevent those terrible attacks? So that is essentially where most of this started. In 2018, this is where the FinCEN CDD rule came into play, where you have to collect and verify beneficial ownership. Now, verify is a kind of sticky word there, or where do we verify it? No, we're kind of taking it at the surface of what they tell us, and it's our job to investigate further if we have any potential concerns. But for the most part, it's our job as institutions, and it still remains that way today, to collect beneficial ownership, to say who's ultimately the one benefiting from this, in case law enforcement does eventually need to investigate that further. Ongoing monitoring expectations, while not explicitly spelled out in the CDD rule, FinCEN does require you to monitor for suspicious activity and update customer member information as needed on a risk-based approach. What does a risk-based approach actually mean? Well, that's kind of subjective, if we want to be frank. FinCEN requires that you get in here and you set a board-based policy on what you believe is a risk-based approach for your institution. Now, we all know that reputational risk was removed as one of the concerns within the last 6 months. So that's not necessarily it's something your regulator will be looking at. But in regards to what is a risk-based approach, it's saying what kind of risks are our institution willing to take, and how far do we want to know that that customer or that member or that prospect still fits our risk appetite. So the very key requirements you're required to do is validate the CIP information, which is really understanding, do they have the proper ID information? Do they have a tax ID number or not? What's their physical address, not a PO box? What is their date of birth? And for businesses, it's validating the business, right? Understanding the nature of the relationship is also a requirement. Identifying those beneficial owners, monitoring for suspicious activity, and updating information on a risk-based approach, which we'll go into here shortly. So the key to, obviously, any interaction with your initial prospect is to start off on the right foot, because if you don't start off on the right foot with collecting the right information, you're always trying to play catch up, to understand and get the information that you need to really truly understand who your customer or your member is and understand what the risks associated with that relationship is. So collecting the right know your customer and information up front is obviously key, but also having triggers for knowing when you need to collect what's called enhanced due diligence. And enhanced due diligence is essentially when do we trigger requirements to know more than just the basics of, are they a business? Where do they operate? Are they legitimate? Are they a person? Can we validate them? Do they have ID information? Do we check those CIP boxes? Enhanced due diligence really comes into play when that type of relationship is deemed as more risky, either by you, your institution, or by sometimes the regulatory requirements of FinCEN and in the FFIEC manual, which, you know, I still old school keep the OG here that they don't even print anymore, which has since been updated. But, you know, there's some stuff that hasn't changed in there, so I like to still keep my little notes occasionally in that old school book. But it's all about collecting the proper information at onboarding, not post onboarding. So all of that relates back to frontline training and anybody who's in the account opening team. Do they know how to detect and redirect certain types of customer or member types, prospects, that do require that enhanced due diligence effort? That is a huge component, because if your folks up front don't know how to look for certain types of person or business types that do require more digging prior to approving the relationship, then they're going to onboard them like they're a regular customer or member. And then you're stuck finding out later you've onboarded somebody that potentially might not fit your risk appetite, might be a forbidden business that you say you're not doing business with. It could be a situation where you're also chasing them around for information that you need to validate who they say they are, or collect the information you say you do in accordance with your policies and procedures post onboarding, which is a terrible look for everybody. It's a bad customer experience. It's a bad employee experience to be chasing that information around. So it starts with the front line. It starts with whoever's in touches those account opening and educating on who they're allowed to onboard and teaching them how to ask the right questions in a way that it doesn't feel invasive. It's strategic who you ask enhanced due diligence questions for, right? You don't just have to ask, you know everybody's blood type or where they live, you know, their 14 houses they have necessarily here, there, and everywhere, or, you know, where their kid goes to college, those types of things for everyone. But there are triggers for things like money service businesses or ATMs, or maybe it's different services, products and services that you guys offer that, you know, inherently bring more risk because of the type of money movement. Maybe it's, you know, real-time payments or something like that that require more vetting prior to actually approving somebody for a product and service. So it doesn't necessarily mean that, you know, you have to trigger that for every customer or every member or every prospect. It's about saying these are the folks that we ask additional questions for, and then defining what that process is for asking those additional questions, and then deciding whether or not that individual or that business can actually fit the risk appetite and who has the right to approve those types of relationships. Once you have defined that and you have some type of questionnaire or form that you have that either account opening officer or directly that person or business fill out, then you need to have a defined process on where does it go next to decide who actually gets to approve that relationship. And honestly, it should be separated from that account opening team, because in most institutions, account opening teams have that authority to open relationships and have goals associated with that. And when you have goals, sometimes sometimes folks can put on blinders as to what's actually coming on if they have an actual account number they're trying to reach of how many they're onboarding. So it should be somebody who is separated from that, usually lives in BSA compliance, some type of secondary line of defense, to say, okay, this is what this looks like. This is our program, and now it's my job to trust but verify, right? So there's part of an enhanced due diligence that says not only do we collect this information, but we also need to verify and validate that what they say they're doing, they are doing to the extent that we can tell. But in addition to that, we need to take a look under the hood to make sure that there's nothing hidden that potentially could cause issues. You want to also ensure that your profiles upon setting those up, setting these relationships up after they're approved, even just for regular general run-of-the-mill clients, you want to make sure that it's accurately reflected in your core, whether it be an NAICS code, a SIC code, some type of label you're able to apply, because this helps that back office who's in charge of that, potential extra work and extra monitoring that needs to take place, can categorize these types of businesses or person types into a group and be able to know, okay, my policy and my procedures say this group gets monitored differently than the rest, and this is how I'm adhering to it. So it helps set the stage for proper monitoring. There's different ways to approach that. This is just one way we do it within RiskScout. This was built from, I was in banking for 20 years prior to joining RiskScout. I spent some time in the front office. I spent some time, most of my career, as a BSA officer. So I want you guys to take into account that when I'm telling you that these processes can be cumbersome if you do not think through them and you do not have any type of process in place to be able to help you collect that information, I want you to think through that. It's coming from my own experiences and the experiences of our team members, that it's hard to chase people around for information. So we build this out with that in mind as former bankers, as former regulators. This is one way we do it through an application process. Our institutions are allowed to create any forms they want. This is an example for an MSB. They click on the app, they can collect any questions they want on here. It's all customizable. But the trust but verify section is the first pass report. So once they collect that information, they can choose to submit a request for a first pass report that comes back within about a minute. They can view the report in the UI and see those results. That gives them the ability to say, do I need to investigate something further, or is it good in regards to the sources of truth that we pull from? And this is just one of many examples that folks utilize to achieve this. This is just a streamlined way to do it for our institutions that need a better way, because either they are wanting to scale up a certain program, maybe they have no good tools with the core provider that they have, so we give them flexibility and options to be able to ask any question they want, either from an account opening officer perspective, filling it out on behalf of their prospect, or from that direct business or person filling it out themselves through a link online. It's also important, we talked for a second about segmenting for success. When we talk about this, we're talking about really clearly labeling who your customers are, really knowing that also not all risks are created equal. A custom fit is not, is much greater than a one size fits all in regards to, if you treat everybody who walks through the door, I'm going to open that account for, no matter what business or person type they are. Then I'm going to post panic and find the information after if it doesn't quite work well from an employee or customer experience. So tailoring down to your processes there, and then allowing your institution to be able to put together a list and customize alerts and monitoring for those is a better approach than just doing a blanket statement risk, alerts set for one whole standard group. Because I will tell you from experience that a general population set a group of alerts means you're going to end up with a bunch of false positives all the time, because your MSBs may be more cash intensive, your CTR exempt customers maybe are obviously more cash intensive, your ATMs are different, your NRAs may be different, those things like that. So you want to be able to set custom rule groups and treat those and segment those out to say, I want a certain set of agents or alert rules for these, so I monitor them more custom to what the risks are than what my general population is. You want to build a good baseline first. That helps you understand when your customer is deviating potentially from their standard expected behavior. Now, it's a hill I'll die on. People hear me say this all the time, that if you're collecting information at account opening that is asking your customers what the volume of information, transactions they're going to do, how much ACH in, how much ACH out, how much wire in, wire out, never accurate, never accurate. And if you're monitoring against that information, to create alerts based off of abnormalities that they didn't do what they said they were doing at account opening, you're going to get nothing but false positives. So you'll want to get a baseline understanding of their business operations, what their occupation is, maybe when will they be receiving paychecks, how often is that, things like that, not those really granular questions that are always wrong to begin with. And that helps you better understand, is their activity normal for their occupation or their business type.
Oh, it would help if I came off mute, wouldn't it? All right, we've got our next poll question here, which you should see popping up on your screen. And to kind of go with what Kristin was just mentioning, it makes a big difference on how frequently you're updating those customer or member profiles. Is it actually their most latest and greatest information? Is it just what they filled out at onboarding? Did they really put thought into it? We want to hear from y'all. What frequency are you actually going in and making these updates? Is it real time? Is it when an event triggers? Do you do it on a set frequency, maybe annually or quarterly? Or does it just depend? I would love to hear what people are actually doing on the ground when it comes to updating that expected, anticipated activity. Alrighty, just a couple more seconds if you want to contribute, get your responses in here. Alrighty, most of the folks have given their answers. And again, we've got a pretty hefty majority in one section that are saying over half of folks only update when it's triggered by an event, which that's good to hear that we've got some consistency. 23%, about a quarter of the folks on our call are saying it really depends. Maybe it's depends on the customer or business type, who knows. Only 8% are doing it on a set scheduled basis. And then 12% of the folks that we have on our call are doing a real-time updates or ongoing at whatever cadence makes the most sense to their team. Kristin, how does it stack up to what you tend to see?
Yeah, I think it's appropriate to say only when triggered by events is appropriate for scenarios that carve out those high risk and put them in a different bucket, right? Your high risk customer base that you should have some type of cadence you're reaching out to update information based on regulatory expectation. A triggering event makes sense when it comes to the one-off situations where you're like, okay, we didn't know this wire came up, it revealed this customer is sending unusual, wires over to here, that's not normal for what we normally see for them, and then updating them after that fact is completely reasonable. I think it's important as we walk through this just to know that, I think there's two different views here. KYC, KYB doesn't end after onboarding, and that's true, but it doesn't mean that necessarily you're stuck with, mailing your customers every year to get refreshed information, get them to log on online, to have to, revalidate their information. If that's in your policy, you better be doing it, because that's the letter of the law at that point in regards to what the regulators will be looking for. It's good to refresh that type of information on set cadence, because I'm even guilty of not going in and, letting an institution know that my address has changed if it was just some small savings account I had somewhere. Those types of things are good to update, maybe once every several years through some effort. But the KYB and KYC portion of things, customers evolve, they're living and breathing, and they change over time. So, this is where that segmentation of understanding who the customer is at onboarding and saying, okay, if they're in this certain group or arena of a customer base, maybe we should consider, instead of every 3 years trying to refresh information, we want to say every year, if not sometimes more often, we want to say, has your business model changed? This is more applicable to businesses than it is persons a lot of times. Maybe if you have politically exposed people, you need to be more abreast and stay on top of that. I don't have a lot of institutions that I know of that are huge pet populations, but from a business side of things, you're finding that these businesses, either they were a different type of businesses when they onboarded, and then they morphed into something different, business model changed. And now that business model that changed bumped them from a low risk category potentially to a high risk category. And maybe you only figured that out because of a wire that needed to be approved, or some type of ACH, or, some type of transaction alert that triggered. But those types of clients, there are certain type of that you need to be reaching out to more frequently to understand what the nature of their business is, to understand that, only understanding what their business is today and not when they onboarded 5 years ago ensures that you are monitoring and understanding and knowing your customer or your member for the longer term, so that you can ensure that the activity that's happening in the account today is commensurate with the stated nature of the business as it is today, not what it was 5 years ago. It's important to define what those triggers are of when you need to reach out to that client for more information. So that could be because of unusual activity. Maybe they've requested, treasury management services, things like that, that you need. That's a trigger for a refresher, right? That could be just your general population client, not somebody segmented into a higher risk group, potentially higher risk group. This is just general good practice for saying, this is when we do enhanced due diligence. We collect, we want to understand, how are you operating today? Where do you typically send money to? How often are we expecting these? So when something falls out of that norm, that's when you can be suspicious of it and investigate further. So you're not just chasing rabbits everywhere that are not fruitful, essentially. The triggers can also be something along the lines of, we know this now, this customer is in one of these higher risk segments. Maybe they're ATM, maybe they're hemp business, maybe they're, crypto, something along those lines. And we do want to put them in a program where we do reach out to them more often on a set cadence, so that we do know every 6 months, have they changed? Have they bought are they serving a new customer base or member base themselves? Sometimes it is knowing about your customer's customer, because who their end client is may affect how you guys rate them and what you're looking for in regards to what is suspicious. So it's really important to say, if you do have customers that fall into unique categories that really through the FFIEC manual or through FinCEN are deemed as riskier clients, then you need to have some type of program that you do refresh information on set cadence, because I will tell you that your business, who they were when they onboarded today, any business wants to grow, right? So they're not going to be the same as when you onboarded. And especially if they're in a higher risk category, that means they're in a situation where they are going to change potentially quicker. This happens all the time in the hemp and cannabis industry, where people gobble other people up. People start out as a grower, and then they find out it's better for them to be full cycle, so they become a processor and a retailer. And those risks change their risk profile, so it's important to keep up with who they are, so that again the activity is commensurate with the state and nature of the business, but also do they still fit your risk appetite, which is just important. When you do scheduled reviews of information on a client based off of, maybe you did reach out to have information refreshed, and what you got back, it triggered you to have to potentially do a deeper dive review, or maybe you do have a scheduled review that occurs because you say, I do look back at these customers at least annually to say, okay, I do have transaction monitoring, and that's monitoring daily, but over a period of time, I'm going to do a look back to say, really truly was this activity reasonable for the state and nature of that business or that person's occupation. What you want to do is ensure that you have less friction there. So if you do need to reach out to that client to collect information, to complete your review process, there's oftentimes where I was in a boat where I had a big MSB portfolio, so I was oftentimes in a scenario where I could do the transaction look back review, but I needed to recollect policies, latest audit results, so on and so forth from there, who I'd have to call a relationship manager to reach out to that client to then collect the information. And then the cycle just never ended there because they would have to collect whatever information. They're mad about having to do BSA compliance work to begin with. So I think it's important to have that kind of laid out institutionally to say, this is our process. We will be reaching out to these certain client sets on these certain bases. Let your relationship managers know, and then have some type of process to help streamline that whole process altogether, because there's nothing worse when there's tension between your front office, who's trying to do sales, and your back office, who's trying to do their regulatory work, and nobody who does in sales ever wants to do compliance work. Only the cool kids want to do compliance work. Consistency is key. You've got to ensure that the experience for every customer, when you're collecting that KYC information, that you're keeping it consistent. Your team isn't trying to reinvent the wheel every time they're trying to collect information, additional information on the client after they've onboarded. And the better the data, the more accurate the information, the better decisions you can make, again, to ensure that they fit your risk appetite and your program goals. We talk a lot about, updating information. I think it's also most important to keep your customers and your members engaged, to understand why you're collecting that information. Finding your customer or your member after they've onboarded to give you any information is one of the hardest jobs out there. Like it's impossible to find. And they'll tell you anything in onboarding, but then poof, they disappear and say, no, you've got my money, I can do what I want now. So I think the ability to get in here and really help them understand at onboarding that sometimes you may reach out to refresh information, and especially if they fall into a segment where that is going to become obviously more frequently from the start, it's all about setting those expectations to say, sometimes we will be reaching out to you through this method, and this method is where we expect you to communicate back. And lack of communication back to me does not bode well for you. And you can say that in whatever kind of way you want to. I used to say, you've got to help me defend why I chose to bank you, not only to my regulators, but to my own peers. So I expect you to still communicate with me. I've not worked in a bank in 5+ years. I still have customers from my old institution text me to tell me they're going to go do a transaction, for me to tell them, I remind you, I don't work there anymore. You need to call them directly and let them know. So I think it's, setting that expectation and that understanding with them from the beginning creates a better understanding for them to say, first of all, they don't think you're being invasive. They have an understanding of why you're asking. and you create a better, more communicative relationship that way, where they feel like they can trust you and they can tell you things, and it's a proactive relationship like that is much better than a defensive relationship. In RiskScout, we use something called tasks and checkpoints to reach out to clients. Tasks are immediate communications with your client. What this does is allow our customers, when they do have scenarios that maybe potentially involve fraud or one-off triggers, they don't have to go email that client through their own email, chase them around, phone number, go knock on their door, whatever means. They can actually send a direct communication to that client, who they get notification via email. We're a web-based company, so anywhere they can access the web, they can pull up that message and respond real time back and forth with the client. What's also nice is they can change, that client can change it to whatever native language they speak, which would help me hugely with my MSB program, since Spanish is not my native language. This is an actual scenario that happened with one of our customers, where they had a trigger where a wire was being sent out that was unusual for that client. In that regard, they reached out to the client through tasks, asked them, what they were doing. Client said, "Oh, I'm a hemp business now, actually, and I'm sending a $100,000 wire to China for this equipment." And they were able to report back to them and say, "Can you please provide us an invoice?" The customer complied, attached that invoice, and 4 minutes later, that communication was done and the wire was sent. So I think it's really important just to ensure that whatever means you're doing, that whether it's through that or whether it's through whatever means that you guys decide is important for your institution, to define how you're going to reach out and then set those expectations with that client. The faster information you can get back and forth without chasing somebody around is a better customer or member experience, but it also allows to make better, more risk-based informed decisions quickly. So that's part of the protection that you have for yourself and for your job, to say that we want to help you, customer and member. We just want to make sure you're protected too. So this is the way we're going to communicate with you when we have questions or concerns. Common pitfalls are a huge issue in this space. Consistency is the name of the game, right? Oftentimes the pitfall is your policy says you do one thing. I reach out to these clients to refresh information at least annually. I document a review at least annually. This is what I do annually or semi-annually. And then when your regulator comes in, it's always about proof that you're doing what is said you're doing in your policy, right? Their first job is to say, does your policy at least adhere to the minimum of what you're required to do per regulations? Yes. Now it's my job to say, are you doing what you say you're doing? Over-engineered policies are a kiss of death. If you don't give yourself a little bit of wiggle room in your policy, you are going to back yourself into a corner accidentally, and you're going to be held reliable for that. So what you want to do is make sure that if you say you're doing something in your policy, you not only are doing it, but you have a robust way of proving that you are doing what you say you're doing. Another common pitfall is the risk rating methodology. It was, I think, a couple years ago, 2-3 years ago, time is a blur, after COVID. If you can't tell time anymore, years are decades now, it feels like. But risk rating was a topic that came up within the last couple of years from FinCEN that says we don't want you blanket stating risk ratings on everybody. Just because they fall into a certain category doesn't mean they present the same type of risks. Just because they live in a certain industry or certain geographic area doesn't mean they all present the same type of risk. Your mom and pop MSB store that cashes $2,000-3,000 a month in checks versus your one around the corner that does $300 to $3 million a month in checks, completely different risks, right? So the problem with most systems is it's a Boolean risk issue, right? you're either high risk or you're not high risk. And they don't allow you to weight certain factors in there that say, just because they live in this area, have they done anything from an activity side of things that should warrant us raising them up? If not, then should they even be high risk? No, maybe they should more in a moderate or a low risk setting. There are big issues in certain areas in seeking out and looking and doing due diligence where we don't ask the right type of questions, right? We don't ask enough sometimes. Maybe we ask too much. Maybe we're too conservative where we're asking so much we're missing the forest for the trees. So I think it's important to understand that a risk-based approach means that you're refining your questions down to the point where you can decide, do they fall into a category that I believe that warrants additional review prior to onboarding? And if they do I have a proper, am I asking the right type of questions here that will help me determine, should I bank them or should I not bank them?
All right, that brings us to our next poll question, where we want to understand how you are tracking or documenting your risk levels at your financial institution. And we know this can kind of run the gamut. There's a lot of different ways that people are approaching this. So that could be anything from, maybe it's manual, maybe your frontline staff is the one doing those updates. Maybe you're using a BSA system and it's either manual there or automated. Maybe you don't have a set process in place, or it's a little bit more ad hoc, and a combination of all these. So we'd love to get a feel for what y'all are doing today. Maybe get a little insight into how it's working for each of you. All right, we'll give just a couple more seconds to get your responses in here before we flip these around and talk about it a little bit. All righty, thank you all so much for being so quick on these poll responses. Greatly appreciate that. And of course, sharing your insights. A little bit more evenly spread than we've seen throughout the rest of the presentation. We have 43% that say their BSA system, they're doing it in there and it's automated, right? They're either maybe being weighted or processing some, maybe it's bullion, but it is an automated process. 20% of the folks also using BSA AML software, but it is still a little bit more manual. Manual kind of continues a little bit as we see spreadsheets and manual logs. Only 6% are relying on that frontline staff, those tellers, to do their updates for those risk levels. 8% reporting that they don't have a process set in place today. Kristin, how does this hit your ear?
That does not surprise me. A lot of the legacy BSA systems out there still do require you to go in and manually update systems, but a lot of folks still run their BSA programs manually. So relying on your frontline or we're waiting for them to onboard and then using some type of calculative spreadsheet, that's not uncommon. And I've been there before, and I'm sorry you have to do that. So.
Well said. Thank you all for your responses there.
I think, when we talked about common pitfalls, when we were building out our BSA system, we wanted to rethink risk ratings. This is just a small screenshot. This isn't the whole shebang of what everything is considered. I just think it's important to really think about how you're risk rating clients and not necessarily profiling them or just sticking them in a certain category just because marking them as high risk because they fall into a certain category. That what we just talked about, that guidance that came out, really honed in on the fact that not every customer or member presents the same type of risk. I also think it's important when, however you're doing it, either manually or in a software, you have flexibility in determining what weight should be considered and what is considered high risk. We took an approach where we kind of were influenced off commercial credit underwriting matrix approach to say, okay, we're going to take two different sets of information: profile risk grade and activity risk grade. And profile is more surface level, and activity is what's really happening and what decisions have we made on them. And then based on those two factors, they're A, B, C, 1, 2, 3, and then they are put into a category that that marks them as low, moderate, or high. As you can see here, we can change those what triggers it into a low or moderate or high, or these scale settings are flexible here. I have some institutions who are say, okay, just because I'm more conservative, if anybody ever falls into a C category, I always want them to be high risk. So we move them and move that category to high risk, and they automatically will fall there. It's a living, risk rating should be kind of living, breathing, right? So all of our customers run through the risk rating nightly, and if some factor has changed, it will change that risk rating accordingly, and you'll be notified. There's a whole process to that. But it's all to say that you shouldn't just be stuck with a black and white. This is the way it is, and you get what you get, and you don't pitch fit, because every institution is its own snowflake. They should be able to have flexible risk ratings that fit their risk appetite. I have some customers who could care less if their customers in a hit or hit area, and some other institutions are very concerned about that. So, it's all to each their own. We've talked a lot about this interagency guidance about saying, stop blanket stating risk. And I encourage you to really implement a multi-tiered risk rating system that is flexible and breathable, like we've talked about. And, we'll wrap up here on best practices, just, policy, practice, proof. Live it, breathe it, understand that, again, don't over-engineer your policy. Whatever your policy is, you have to say you're doing it, but you need an easy way to prove that you're doing it. Be exam ready, not exam rushed. Your program is living and breathing. It's changing who lives in your area, what businesses are in your own backyard. You need to be aware of that and know that, so that you're getting ahead of the risks before they get ahead of you, essentially. Being exam ready means that you're not just panicking to get stuff together before then, that you're actually saying and assessing your program on a more frequent cadence, so that if you do find a problem, you do find an area that has concern, you're able to approach it more proactively and not just try to scramble to fix something 2 to 3 weeks prior to an auditor or examiner coming in. It's always about showing your work. If it's not documented, it didn't happen, right? So that's why logging notes, logging, when you did something, dates matter. Sometimes you do say in my policy, I'll do something at least annually. I have some institutions that I know that manipulate that annually to be quite a living, breathing thing itself. I did it in January. I said at least annually, but I don't do it till December of the following year. I still did it annually, but that's still like 24 months between reviews. Be a little bit more cognizant of that. Still, again, I would not back yourself into a corner with the policy, but I would be cognizant of the fact that, those longer timeframes can be a little upsetting to auditors and examiners. Consistency is key. So again, remember, it's your front line, your first line of defense, your account opening team. Teach them what you do and do not want to bank when things require enhanced due diligence. Know that, general run-of-the-mill KYC and KYB is good for general population, low-risk clients. But give them information and educate them on what those triggering keywords are. Give them the right tools, give them the right training to know that they're not being invasive into somebody's privacy. They're just trying to understand and know who's coming on board so they can better protect the institution, and help them understand to know when to detect and redirect those certain types of clients or prospects to a different team member for vetting prior to onboarding. If you find them post onboarding, that's okay, don't panic. It happens. It's just a matter of, the less you have to go and chase somebody around after onboarding, the better. This is one way we do due diligence reviews in RiskScout, where we do allow our clients to schedule reviews to occur on whatever set cadence with whatever template they want. They get in here and to the scheduled review, completed and accordingly. I like about this a lot, not my favorite piece of RiskScout, but a great component of RiskScout is the audit and exam prep. So, examiners have consistency in what they're looking at, because everything is PDF or CSV exportable from RiskScout. So it comes in a nice consistent package, zipped file. If there's attachments, they're zipped up in that file too. So from that audit and exam prep, when you're panicking, oftentimes before I had any software, it was like, okay, we would do a review, but somebody would stick it in the wrong folder. So when you go to get that review out for your examiners, you can't find it. It's named something wrong. So it's always chasing around. Like, I know I did that review. This just provides you a better way to document you are doing what you say you're doing. So when is KYC, KYB good enough? It's when it aligns with your policy. So again, if you are doing what you say you're doing, when it supports a risk-based approach. You know, everybody's risk appetite is much different. I've got institutions all over the board on what their risks are. It should not be a one-size-fits-all for everybody. Everybody has different geographic locations, have different products and services, and expertise on staff to be able to actually offer riskier services. Sometimes that opens up their risk appetite. So it's all about, you know, to each their own in regards to that, but help your, you know, make sure it's defined at your institution from the top down and really spread as the gospel around. When it's actionable is another one. The information collected should allow your BSA team to be able to monitor folks properly. You got to trust but verify. So, you know, you have your general account opening CIP verification in most institutions, that's great. But when it's one of your riskier clients or somebody you just like, you know, feel you have an icky feeling about, it's a trust but verify. You want to make sure you have tools in your pocket to do that. And then when you can defend it to your regulators, I am accounting for the risks that my institution has taken on, and this is how we're protecting ourselves of knowing our customer.
All right, y'all. That brings us to the Q&A portion of our webinar, where you all, our audience, can ask Kristin any of the questions that you have about today's topic. And thank you to those that already have. Greatly appreciate all of those. Now, before we do dive into all of your questions, we have one final poll question that you should see popping up on your screen now, asking if you'd like to get in touch with the RiskScout team, myself, Kristin, anyone else that we have about any of the following. You can select as many or as few of these responses as you see fit, so a little different from our previous polls. And we'd ask that you go ahead and take this time to submit any of those questions that you may have into the questions section on the control panel on the side of your screen for our webinar, and we can dive in there. Kristin, we had a good amount of questions come in here. Let's see. A question that we had about early on, we were talking about customer profile updates, when you do them, when you shouldn't do them, how often does that happen? Are there any expectations that regulators have on what that frequency should look like? Maybe best practices for what we should set that timing to be in our procedures?
Yeah, I mean, that goes back to the risk-based approach, right? How risky are those clients? Just because you bank MSBs, if it's teeny tiny mom and pop MSBs on the corner, less frequent. If you're doing something more high volume, high dollar, the expectation is at least annually, if not more frequently. You've got to think about when you're collecting that information, you're going to look through it and validate it, and you should be doing some type of look back review to ensure that the activity is reasonable for what they say they're doing. Now, if they're a large volume account, it's hard to do that over a year's time frame. So there's oftentimes, they're encouraged, my regulators, because we had the last institution I was at, we banked about every high risk industry under the sun. So I definitely have a lot of cheeks in the seats experience doing that myself. The advice we got from the regulatory agencies when we came in, when we were doing annual reviews, was to say, if these higher volume ones, maybe push it back to even quarterly, because your look back review is so big based on their relationship that it's more digestible to look at them in chunks of quarters and more reasonable than it is to expand that out in that period of time for longer, because who knows what could go wrong in a year as well. So it's definitely more on the volume of activity, the type of activity. And I would say if the larger, I wouldn't do more than 6 months if they're riskier.
Thank you for that, Kristin. We had another question coming in about kind of validating and particularly validating for signers of businesses. Is there a best practice to verify an individual that's a signer but maybe not a beneficial owner? Is that something that needs to be done in person, or this person gave a specific example of a bookkeeper that's an authorized signer but not a beneficial owner of that entity? Is that something that you need to do EDD on? Are they just doing traditional CDD? How are you kind of handling or navigating that process?
Yeah, that's a great question. It really is a lot about your policy, right? But most of the time from an authorized signer perspective, who's not a beneficial owner, you're still doing some type of a little bit beyond just saying, if somebody were to walk into a door and say, I want to be added to this business account, somebody who's authorized already on that business account is the one who should be coming in with that individual, or at least authorizing with the party that they know, like a commercial account opening officer, to say, hey, I'm sending Judy in to be added to this account. You never want to just let an individual walk into the door and say, I can be added to this account. Even if they are their bookkeeper, there's relationships that are contentious. You don't want to get in a situation where you add somebody to account erroneously and then all the money's gone, and now you're in a deeper conversation that you would want to avoid. So it's usually with somebody who's already authorized on the account that is with that individual that's wanting to add them there. And the best practice is that should be done in person.
That's great. That's great. Yeah, it sounds like another opportunity, to your point, for maybe some frontline training to make sure that that follows through throughout the institution. We had a couple questions come in about communications with customers and members. This question said, is it who really should be initiating that? Should it be the back office BSA officer? Is that something that's best to be initiated by the relationship manager? I've heard mixed recommendations and would love your input.
Yeah, so I think it is about a collaborative effort, right? Without technology, and BSA officers are notoriously like the wizards behind the curtain, right? They don't want to be seen or known and asking the questions, and that's understandable because sometimes we're looking at stuff that is suspicious, right? And we don't want people to know about it. That said, oftentimes you'd reach out to the relationship manager to reach out to the customer. In RiskScout, the way it works is that all parties have a login and know what is going on with those types of relationships. So when there are requests for information, that relationship manager knows about it. They can be the one that follows up, but everything is just generally branded as that institution and just not from a particular person, so that they get, they know that no matter what, that bank is asking for information, not one individual. So it's all about, I would keep the front line informed if they have a relationship manager. The last thing you want them to do is be caught off guard about a situation with their client. So if you don't have that technology in your pocket to do it, I would involve the relationship manager, at least knowing that that's happening.
Excellent. Thank you for that. I think we've got time for one more question here. Somebody asked, what do you do with your CDD and EDD documentation after the customer closes their account? Is there a length of time that I need to hold on to their application, documentation, and other information?
5 years.
There you go. I like that short and sweet. 5 years. Excellent. All right. Well, I think that covers us for questions. I know we didn't quite get to everyone. No worries at all. Kristin and I like to follow up with y'all after the webinar session to make sure that we're answering your questions to the best of our ability. So thank you for submitting those. And if there is a question that you have that we didn't get to answer today, or you didn't feel comfortable submitting it, no worries. You can always find us at RiskScout.com. We're always happy to weigh in and assist in any way you want. I believe, Kristin, you could also flash up your contact information, my contact information here. We love to get emails and answer those questions. So please feel free to follow up with us individually, whether it's about this webinar or something else entirely. Now, that is all of the time that we do have for today. Thank you to everyone that took some time out of your busy days to join us, and a massive thank you to Kristin for not only sharing your time and expertise, but pulling these resources together and sharing them with us. It really means a lot. Be sure to keep an eye on your inbox. We'll be sending out the recording, today's slides, and any additional resources from this session. Those will hit your inbox tomorrow morning. We'll also have a brief survey following today's webinar where you can provide us with some feedback and any requests that you might have for future webinar topics. We love to hear from y'all. We want to know if we're on the right track and if there's anything else that we can be doing to support y'all in your education and training sessions. If you do have any additional questions, if you want to learn more about RiskScout, or if you just want to say hi, come visit us at RiskScout.com. We hope to see you at our next webinar. Kristin, thanks again.